Imagine waking up tomorrow morning and finding out that your paycheck buys less than it did yesterday. Gas prices jump overnight. Groceries suddenly cost more. Mortgage rates climb. Your 401k loses thousands of dollars in a single week. You didn't vote for any of it. You didn't approve it. Yet somehow your financial life changed almost instantly. That raises a question most people never stop to ask. Who is actually controlling the economy? Is it the president, Congress, billionaires, Wall Street, the Federal Reserve? Or is there someone else quietly pulling the strings behind the scenes? The truth is both simpler and more complicated than most people realize. There isn't one person sitting in a secret room controlling everything. Instead, the economy is shaped by a handful of incredibly powerful institutions, millions of individual decisions, and forces that often compete against one another. Once you understand who really has influence, you'll never look at money, inflation, or the news the same way again. Most people naturally assume that the president controls the economy. After all, every election seems to revolve around jobs, inflation, taxes, and wages. When times are good, politicians take credit. When times are bad, they blame the previous administration. But the reality is far more limited. A president can propose tax cuts, approve spending programs, negotiate trade deals, and sign economic legislation. These decisions absolutely matter. Lower taxes can encourage businesses to invest. Infrastructure spending can create jobs. Trade policies can affect prices on imported goods, but none of these changes happen overnight. Many take years before their full effects appear. More importantly, there are several parts of the economy that even the most powerful president cannot directly control. One of those powerful forces is the Federal Reserve, often called simply the Fed. If the economy had a thermostat, the Fed would be standing next to it. Unlike Congress or the White House, the Federal Reserve operates independently from day-to-day politics. Its primary mission is to maintain stable prices, maximize employment, and keep the financial system functioning. The most powerful tool it uses is interest rates. When inflation becomes too high, the Fed raises rates. Borrowing becomes more expensive. Mortgages cost more, credit card interest rises. Businesses become more cautious about expansion. Consumers spend less. Over time, demand cools down and inflation begins to slow. When the economy weakens, the Fed does the opposite. Lower rates encourage borrowing, investing, hiring, and spending. This is why millions of Americans who have never heard a Federal Reserve speech still feel its decisions every single month when they pay their mortgage or check their investment accounts. This is also why investors pay such close attention whenever the chair of the Federal Reserve speaks. Sometimes a single sentence during a press conference can move trillions of dollars across global markets within minutes. Stocks rise, bonds fall, the dollar strengthens, gold reacts. It's not because the chair controls companies directly, it's because expectations shape behavior. Businesses plan investments based on future borrowing costs. Banks adjust lending standards. Consumers decide whether it's a good time to finance a car or buy a home. Expectations become economic reality, but the Fed isn't acting alone. Another major player is Congress. Congress controls taxation and government spending, often referred to as fiscal policy. Every year, lawmakers decide how much money the government collects through taxes, and how much it spends on everything from highways and education to defense and social security. During a recession, Congress may increase spending to stimulate demand. During periods of excessive debt, lawmakers may attempt to reduce deficits. Every dollar spent or tax changes how money flows through the economy. Yet these decisions are often influenced by politics, negotiations, elections, and public opinion, making fiscal policy much slower than monetary policy. Then there are commercial banks. At first glance, banks simply seem like places where people deposit money and take out loans. But banks actually play a huge role in creating money itself. Through lending, banks expand the money supply. When someone qualifies for a mortgage or a business loan, new purchasing power enters the economy. If banks become cautious and reduce lending, businesses delay expansion, families postpone buying homes, and economic growth slows. If banks aggressively lend during periods of optimism, spending accelerates, investment increases, and the economy often grows faster. This balance between confidence and caution influences everything from local employment to national GDP. Wall Street adds another layer of influence. The stock market doesn't directly control the economy, but it reflects confidence about the future. Rising markets encourage businesses to raise capital, hire employees, and invest in expansion. Falling markets can produce the opposite effect. Millions of Americans also have retirement savings invested through 401(k) plans, pension funds, and mutual funds. When markets rise, families often feel wealthier and spend more. Economists call this the wealth effect. When markets fall sharply, consumer confidence often weakens, causing people to spend less and save more. Sometimes emotions alone become powerful economic forces. Then there are the corporations themselves. Companies decide whether to hire workers, build factories, develop new technologies, or increase wages. A handful of massive corporations employ hundreds of thousands of people and influence entire industries. When a major retailer raises wages, competitors often follow. When technology companies invest billions into artificial intelligence, entire supply chains shift. When energy companies adjust production, fuel prices respond across the country. Corporate executives don't control the economy, but their investment decisions collectively shape productivity, innovation, employment, and consumer prices. Consumers may actually be one of the most underestimated forces of all. Every time people choose to spend, save, borrow, or invest, they send signals throughout the economy. Consumer spending accounts for roughly 2/3 of the U.S. economy. When households feel financially secure, they buy homes, cars, vacations, electronics, and restaurant meals. Businesses respond by hiring more workers and increasing production. When consumers become fearful, they reduce spending. Companies earn less revenue, hiring slows, and economic growth weakens. Millions of individual decisions combine into one enormous economic engine. Global events also have enormous influence. The United States may have the world's largest economy, but it does not exist in isolation. Oil prices can surge because of geopolitical conflicts thousands of miles away. A factory shut down overseas can delay products in American stores. Shipping disruptions can increase costs across multiple industries. Currency movements affect imports and exports. Even weather events on another continent can influence food prices in American supermarkets. The economy today is deeply interconnected, meaning no country has complete control over its own financial future. Technology has become another invisible controller. Automation changes labor markets. Artificial intelligence increases productivity while eliminating some jobs and creating others. Digital payment systems accelerate commerce. Algorithms influence investment decisions in milliseconds. Companies using advanced technology often outperform competitors, changing entire industries almost overnight. Every technological breakthrough shifts productivity, wages, business models, and long-term economic growth. Psychology may be the most powerful force of all. Economies don't run purely on numbers. They run on confidence. If businesses believe demand will increase, they hire more workers before sales even rise. If consumers fear a recession, they reduce spending before losing income. Investors buy stocks because they expect future profits. Banks lend because they believe borrowers will repay. Expectations influence behavior, and behavior shapes economic outcomes. Sometimes fear creates recessions. Sometimes optimism creates booms. Confidence itself becomes an economic asset. That brings us to another important reality. The economy isn't something anyone completely controls. It's an incredibly complex system made up of governments, central banks, corporations, investors, banks, workers, entrepreneurs, consumers, and international markets. Every day, billions of financial decisions interact with one another like an enormous network. Sometimes these forces work together. Sometimes they push against each other. The Federal Reserve may try to slow inflation while Congress increases spending. Consumers may cut back while corporations continue investing. Global oil prices may rise while domestic demand falls. No single institution wins every battle. This is why economists often disagree about what will happen next. They aren't studying a machine with predictable outputs. They're studying human behavior, politics, technology, international trade, demographics, psychology, and finance all at once. Every forecast contains uncertainty because the economy itself is constantly evolving. Understanding who influences the economy gives you something far more valuable than predicting tomorrow's stock market. It helps you recognize which headlines actually matter. Instead of reacting emotionally every time markets swing or politicians make bold promises, you begin asking smarter questions. Is the Federal Reserve changing interest rates? Is consumer spending slowing? Are businesses investing more or less? Is inflation rising because of higher demand or global supply problems? These questions provide much clearer answers than political slogans or social media debates. At the end of the day, the biggest surprise is that no one truly controls the economy, not the president. Not Wall Street, not billionaires, not even the Federal Reserve. Each one holds a piece of the puzzle, but the economy is ultimately the result of billions of decisions made every single day by governments, businesses, investors, workers, and ordinary people. It's a living system that constantly adapts, grows, contracts, and evolves. And while you may never control the entire economy, understanding how it actually works gives you something just as powerful. It allows you to make smarter financial decisions, protect your wealth during uncertain times, and stop being surprised by the forces shaping your money. Because once you understand who really influences the economy, you stop chasing headlines and start seeing the bigger picture that most people never notice.